Welcome and thank you for joining us. My name is Kara McGraw, and I'm a staff attorney with the Legal Aid Foundation of Los Angeles. We also have Robin Smith with us, senior attorney at LAFLA, who will help and screen and answer questions in the chat. So, how to prepare for the start of federal student loan payments. So as a reminder, today we're here to talk about preparing for the start of federal student loan payments. The 3-year COVID-19 payment pause and 0% interest most federal student loan borrowers have benefited from since March 2020 came to an end. Interest started accruing again at the beginning of this month, and payments will be due starting in October. If you're worried about affording your monthly payments on your federal student loans in the coming months, if your loans are in default because you couldn't afford your monthly payments in the past, if you've never made a payment on your federal student loans before because you graduated or withdrew recently or during the payment pause, or if it's just been a while and you want to know the steps you can take now to manage your federal student loans and exercise your rights, this webinar is for you. We want you to leave this session understanding that there are a lot of rights, protections, and flexibilities that come along with your federal student loans, especially for low-income folks like our clients who qualify for our free legal services. These options exist to protect those again, especially low-income folks or those who've lost their jobs or those with high student loan balances from struggling with a lifetime of debt just because they took a chance to pursue a higher education. All right, so some of you were here with us before. We'll go over some of the same material, but we'll have some important updates. But just so you know, for example, what if I told you that if you do not proactively raise your hand to select a repayment plan for your federal student loans, you are automatically placed on the repayment plan that may, depending on the circumstances, have the highest monthly payment amount for you. But that if you raise your hand and request a different repayment plan, depending on your income and household size, you may qualify for a monthly payment that is as low as $0 a month, and that allows you to make progress toward eventual cancellation of any balance that remains after a certain number of years. Or what if I told you that there are usually only a couple ways to get out of federal student loan default, and you usually only get to use each way once. Once you've used it up, it's gone. But that for a limited time, the Department of Education is offering a one-time streamlined third way, just a 5-minute call, to get your federal student loans out of default. And then what if I also told you that if you couldn't afford to make payments starting in October, especially if you don't qualify for a $0 monthly IDR payment, that there still may be some other flexibilities and protections available to eligible federal student loan borrowers for the next 12 months. I also just want to highlight before we get started that access to these rights, protections, and flexibilities is free. So you never need to pay anyone to access these. All right, here's our agenda for today. If you have federal student loans, it's important to know the rights and protections that come with them. So today we'll go over the following. 1, knowing how to get trusted and where to get trusted information you need to manage your federal student loans, how to request an income-driven repayment plan, how to get out of default by requesting fresh start, and then finally, I'll also go over some temporary protections most eligible federal student loan borrowers can automatically access, especially if you cannot afford to start making payments on any repayment plan in October, starting in October. So the department has been referring to these temporary protections as an on-ramp period to protect folks from the harshest consequences of missed, late, or partial payments. All right, here's an update from last time. Many of you probably heard about the Supreme Court decision that struck down the the Biden-Harris debt relief plan that would have canceled up to $10,000 or $20,000 in federal student loans for eligible borrowers, using a national emergency authority called the HEROES Act. On June 30th, however, the Supreme Court made its final decision preventing the Department of Education from moving forward with that particular plan using the HEROES Act authority. Just know that all the options for relief I'll be speaking about today are still currently available and are not affected by this particular Supreme Court decision. And then also just know that the Biden administration is starting a process called negotiated rulemaking to try an alternative pathway to provide much needed debt relief for folks. So this alternative pathway will not rely on the HEROES Act, and we don't know what the proposal will look like yet. It will also take several months or maybe even a year or more for the department to go through this process. But if you're interested in learning more about it, you can check the link that I included on the slide. Okay, end of the COVID-19 payment pause. So as I mentioned, payments and interest were paused for most federal student loan borrowers since March 13th, 2020. So that's more than 3 years. The pause has been extended several times, but a new law prevented any further extensions of the pause, and it has come to an end. This means that interest started accruing again on September 1st, and payments will be due starting in October. So you should, or maybe you should have already received a notification from your loan servicer, and this should be at least 3 weeks before your first payment is due in October. The best way to be proactive and to be sure that you get the most accurate and up-to-date information you need about your federal student loans and the options and rights that come along with them is to check studentaid.gov regularly. This is the official authoritative Department of Education website for information about your federal student loans. And as we're going along the webinar today, if you have any questions that I don't address or you want to read more about any of these options, you can always find the answers at studentaid.gov. Also, as we've seen, there are new announcements all the time and changes. So, check back here often to get the latest. Okay. If you haven't already, here are some steps that you should take to prepare for payments that are resuming again. First, create or log in to your studentaid.gov account. You can access it at the same link I mentioned before, studentaid.gov, the official authoritative website for federal student loans. On the screen, you'll see something like the icon on the left of the slide that says log in/create account. You can click the one that applies. And then just note, if you're using a mobile device or if you have a narrower internet browser open on your computer, these buttons might instead look something like the little person icon you see at the top right of the slide next to menu. So you can just click this icon. Once you click, you should see a screen like the one below with login and password information, and ways to retrieve them if you've forgotten them. You'll also see a button there for creating a new account if you haven't set up your account yet. Note, some folks may run into trouble retrieving or creating an account, but don't panic. If you run into any problems at all, call the Federal Student Aid Information Center at 1-800-433-3243. And they should also have folks available to assist in other languages as well. They'll tell you what you need to do to regain access to your account or how to create it. They may ask you to submit a form of identification documentation, and it can take a while for them to fix the problem, maybe around 7 business days. All right, once you're logged into your student aid account, there are several things you should do. The first is you should update your contact information, including your email address, your phone number, and your physical mailing address. This is really important so that you're sure to receive the most updated information from the Department of Education. I'll just note really quickly that you can also see who your loan servicers are in your studentaid.gov account. Now I believe there's actually a direct link to your official servicer website in case you want to access it from there. And you can see an example that I included on the screen. You should also check if any of your loans are in default, which you will be able to see in your account as well. And if so, just hang tight. We'll talk about requesting fresh start to get out of default in a few minutes. And then you can also check what kind of student loans you have. So I included some information on the slide about how you can access that information. You'll see your loans listed there. And so you can see, for example, I'll be talking about this later, but you'll see if you have a Parent Plus loan, you can see if you have FFEL loans, you can see if you have direct loans, etc. Okay, making sure you have an affordable monthly payment, income-driven repayment. So I mentioned before that if you don't affirmatively select a repayment plan, your servicer will automatically place you on what's called the standard repayment plan. And this standard repayment plan may have a very high monthly payment for you, particularly if you have a relatively high outstanding balance due, that's what you owe, including interest, compared to your income. So we're not going to focus on that plan today, but we're going to focus on a different kind of repayment plan, an income-driven repayment plan. I'll also be referring to it as an IDR plan for income-driven repayment. Okay, so there are many different kinds of repayment plans available to federal student loan borrowers. And again, I won't be going into all of the details about all of them. I will be focusing on income-driven repayment plans, particularly the new SAVE plan. That stands for Saving on a Valuable Education Plan. So there are a few different types of IDR plans, but again, as we saw on the last slide, but I will be focusing on SAVE, which is replacing the old repay plan. But basically all of the IDR plans work in the same basic way. On an IDR plan, your monthly payment amount is calculated based on your income and your household size. Specifically on the SAVE IDR plan, and I'll talk about this a little bit more in a second, but your monthly payments are calculated as 10% currently of what you make over 225% of the federal poverty level for your household size. And then, really importantly, IDR plans cancel any remaining balance after a certain number of years. It's usually 10 to 20 years for undergraduate loans for the SAVE plan, and 25 years if you have any loans for grad school. And then if you're taking advantage of PSLF, that cancellation period is cut down to 10 years. This cancellation piece is really important. So long as you remain on the appropriate IDR plan that your loans are eligible for and you make your required monthly payment, you can reach cancellation even if your required monthly payment is $0 a month. The department also just made it even easier to remain on an IDR plan and make progress toward that eventual cancellation of your loans on IDR. It used to be that you had to provide income documentation once a year to your loan servicer, and this could be pretty burdensome. And if you didn't, you were removed from the IDR plan. Now, you can approve for the secure disclosure of your tax information as part of your IDR request. If you approve of this, then you won't have to submit income documentation every year to your servicer. It'll just be you will be recertified automatically. Your servicer will automatically have all of the information it needs to calculate your monthly payment for the next 12 months and for you to remain on the IDR plan. Okay, as I mentioned, I will be focusing particularly on how the IDR plan called SAVE works. So the department recently announced a new and improved IDR plan called the Saving on a Valuable Education Plan. This plan replaces the old repay plan. So if you were already signed up for repay, it'll automatically convert into save with several improvements. I also just want to highlight for a second that the save plan is only available for those with certain kinds of direct loans, the not direct parent plus loans. And we'll go over this in a few slides as well. If you have other types of loans, you may be able to take another step, again, which we'll discuss shortly, before you are eligible for save. So I've listed some of the improvements that come along with the new save plan here, but I'll go over some of them. It increases the amount of income that will be protected under the calculation of your monthly payment amount. It protects up to 225% of the federal poverty level for your household size. And if you make up to that amount and not more, you will qualify for a $0 monthly payment. If you make above that, you'll just pay 10% of what you make over that amount as your monthly payment on the SAVE plan. There's also a really great interest subsidy on the SAVE plan. So long as you make your required monthly payments on SAVE, even if that's a $0 monthly payment, the government will eliminate any interest that accrues that your monthly payment doesn't cover. This way, what you owe doesn't increase or your balance doesn't grow. Additionally, you can exclude your spouse's income from the calculation of your monthly payment amount. This was not available under the old repay plan, but only if you're married and file your taxes separately. And then, as we've already discussed, it also allows for the automation of the annual recertification. Okay, so here's an example of how the calculation works out. So the federal poverty guidelines are published annually and are available. I don't believe I included the link on the slide, but they're available online. And I've copied the current chart for 2023 onto the left side of the slide. So you'll see that 100% of the federal poverty level for a household of one is currently $14,580. So to calculate 225% of that, you would multiply it by 2.25. And that gives $32,805. So that means a household of one making up to $32,805 a year qualifies for a $0 monthly payment on the new SAVE plan. If a household of one makes anything above this, the monthly payment amount will be currently 10% of what they make above the amount for the year, and then divide that by 12 to get the monthly payment. I've also copied here a chart from the department's website to give you a rough sense of the income thresholds per family size that would qualify for a $0 monthly payment on the SAVE plan. And here's an example of how the calculation works out for someone who makes more than 225% of the federal poverty guidelines for their household size, and so who doesn't qualify for a $0 monthly payment. So in this example, it's a borrower with a family size of one whose income, the adjusted gross income, is $45,000 a year. So if you look at the chart, again, the federal poverty level for a household of one was about $14,000. And 225% of this, like we did on the last slide, is about $32,805. So you subtract this protected amount from the example borrower's AGI of $45,000 a year, and that gives you $12,195. So that's the amount that the borrower makes over 225% of the federal poverty level for their household size. So currently on the new SAVE plan, this borrower's payment will be 10% of that $12,195, which is again the amount the borrower makes above the poverty, 225% of the federal poverty guidelines for that household size. So 10% of this, so you multiply times 0.1, is $1,219.15. And that divided by 12 gives the borrower's monthly payment of about $101. Note that I put an asterisk there next to 10%. That's what it is now, but as I'll go over shortly, there will be some changes where some folks may qualify to have that 10% reduced down to as low as 5% of what they make over the federal 225% of the federal poverty level for their household size. So just in this example, I've included on the side there, if this person did qualify for the 5% in their calculation, that's how that math would work out. It would essentially cut the monthly payment in half. So as I just mentioned, there are other improvements that will go into effect starting in July 2024, including if you borrow just for your undergrad studies, your payment amount will be reduced from that 10% of what you make over 225% of the federal poverty level for your household size down to 5% of what you make. Also, if you borrowed a smaller amount, you will have a smaller amount for your undergraduate studies. You will have a reduced IDR cancellation period. So rather than needing to make 20 years for undergraduate loans or 25 years, if you have graduate loans of IDR payments before reaching that IDR cancellation, the timeline will be reduced to as low as 10 years if you borrowed less than $12,000 for your undergraduate studies. This is a bit of a simplification, but you can read more of the about the details and improvements at the link that I included on the slide. I do also want to mention, however, that unfortunately, parent plus loans, even a direct parent plus loan, so it's those folks who borrowed federal student loans, for example, for a child's education, those loans are not eligible for any income-driven repayment plans, including the SAVE plan. However, if you take one extra step first, and that's to consolidate those Parent Plus loans into a new direct consolidation loan. So it's essentially just taking out a new loan to pay off those old loans through the Department of Education. Then that consolidated Parent Plus loan then will be eligible for the IDR plan called the Income Contingent Repayment Plan, or ICR. And then for folks with, for example, FFEL or Perkins loans, to be eligible for SAVE, and I'll talk about SAVE even though they would be eligible for another IDR plan. SAVE is by far the most favorable one. All they need to do is consolidate into a direct consolidation loan, and then those FFEL and Perkins loans will also be eligible for SAVE. So I included a link on the slide where you can request a direct consolidation loan. And then you can also apply using the form in Spanish that's available at the link below. It's a relatively easy process to request a consolidation. You'll just want to kind of weigh some of the pros and cons anytime before you do it. For example, if you have Parent Plus loans for a child and also student loans for your own education, you may, want to consider various options there, whether to consolidate them all together or just consolidate the Parent Plus loans. But right now I will mention that there is a pretty big benefit. Some folks may benefit from consolidating before the end of the year because of another initiative the Department of Education announced called the Income-Driven IDR account adjustment. And if you're curious about that, you can read more at the link there. But basically, particularly those with older loans, they'll have an opportunity to receive back credit towards that IDR cancellation period, even if they weren't on an IDR plan in the past. It's really easy to request an IDR plan. So one of the easiest ways is just to go to studentaid.gov/IDR/ which I've included on the slide. And then you can click log in to start, where it says apply for an income-driven repayment plan. And it should just take about 10 minutes to request the plan. You can also submit the request in paper form, and there is a form available in Spanish at the link included on the slide. Okay, so I know that IDR can be a pretty straightforward choice for many, especially those with low incomes relative to the size of the debt, or for those working toward PSLF often. But IDR can also be a vital safety net for anyone if you lose your job. For instance, even though certification will be happening hopefully automatically for those who approve once a year, let's say you lose your job or your income significantly decreases and you're thinking, oh geez, do I have to wait until my servicer recalculates or recertifies my payment for the next 12 months? No, at any time, if you lose that job, you can reach out to your servicer on an income-driven repayment plan and say, hey, I lost my job, I have no income, and then qualify for a $0 monthly payment. So it's a really good safety net to have there. But if you have higher income, lower debt amounts, or have different goals like paying off the loans as fast as possible, or you just want to play with the numbers to see what all your options are, along with an estimate of how much you'll pay over time and how much will be canceled in the end, there's a pretty good tool that the Department of Education provides, again, on its studentaid.gov site, that you can use to estimate what your monthly payments will be under all of the different repayment plans. And I also want to mention that you're generally free to switch repayment plans, and you can pay your loans down faster if you want without a prepayment penalty. And then I'll also note that on the slide there where I included 2 examples, I would be sure to click, when you're going through the loan simulator, click the view and compare all plans to compare all the plans. Otherwise, it might only show you a couple of them based on what you said your goal for repayment was. And then just know that the loan simulator tool makes certain assumptions that are just really rough estimates. For example, it'll ask you what your income is, and then it'll ask you to estimate what percentage of a raise you expect to get every year from your income. And of course, that's sort of impossible in most cases to know. So just use it as a tool for guidance, and try to fill out as much information as you can if you're going to use it, because the more information you fill out, the better the estimate will be. So you'll see in the example on the left, there's an example of the standard repayment plan, which is the one you're placed on if you don't select another one. And then here on the right, you'll see another example with the save plan. And that range of payments just shows, builds in that assumption that that person would have an increase in their income over the years. So, but I definitely do encourage folks who may have other questions or want to see what their different payment amounts may look like on different plans to look at that tool. It's a good starting place. And then I know for some, particularly who don't qualify for a $0 monthly payment, or who might live, in a really high cost area, you might look at your IDR payment amount and think, geez, this is still really high. So you can definitely look at what all your options are there using the loan simulator. Okay, getting out of default, fresh start. You'll probably know already if your loans are in default, or maybe you don't, you definitely may not, but like I said, you can check by logging into your studentaid.gov account and looking there. So there are a lot of very serious consequences generally to defaulting on your federal student loans. And you default on your federal student loans after about 270 days or about 9 months of non-payment. And so I'm not going to go over all of these consequences that I've listed on the slide. But I'll note that, you may owe the entire balance, unpaid balance becomes due, your wages may be garnished, your tax refunds can be seized, etc. And there are usually only 2 main ways to get out of default once you've defaulted on your federal student loans. And those are to consolidate, request a direct consolidation loan to get out of default, or rehabilitation. And so each of these options can typically only be used once. So once you've used it, it's gone. However, for a limited time, for a year after, for the year after the payment pause ended, the Department of Education is providing a one-time temporary third way to get out of default more easily for most defaulted borrowers. And so all it essentially takes is a quick 5-minute phone call. So just call 1-800-621-3115, and the representative who picks up will ask you for some of your basic information to identify your account. In some circumstances, they may transfer you to someone else to call to request fresh start, but you can get all the information here. And then when they ask for the reason for your call, confirm you're calling to request fresh start to get out of default. That's all you have to say. And then finally, you can answer the representative's questions about your income if you'd like to sign up for an IDR plan as well. So again, you can always check out your repayment options on various plans using the loan simulator I showed a couple slides ago. But here are some pretty good facts, or some pretty interesting facts that the department has published about folks who have already taken advantage of Fresh Start so far. So half the borrowers on Fresh Start are paying $0 a month on IDR. So those who use Fresh Start, opt into IDR request, are paying $0 a month. And then 60% of Fresh Start borrowers are paying less than $50 a month when they request the IDR plan after Fresh Start. So again, it's pretty simple. And then once you complete the call, your loans will be transferred to a new loan servicer. Your defaulted loans will be returned to good standing. The record of default will be removed from your credit report. And like I said, Fresh Start will be available for 1 year following the end of the COVID-19 payment pause. But it may be a good idea, to take advantage of this as soon as you can. Okay. I know not everyone is going to qualify for a $0 monthly payment on an IDR plan, even if you do request one. And your monthly payment may be higher than what you can afford right now. I know a lot of folks are facing various financial hardships, and it can be impossible to make the payments that are starting in October, even the ones that are supposed to be more affordable based on the calculations, some of the calculations we went over. So, this can especially be true if you live in an area with a high cost of living. And I know a lot of folks are worried about how to make their payments, even on an IDR plan. So if that's the case, I want you to know that while payments are still due and interest is accruing right now, the Department of Education has announced a temporary on-ramp period to protect borrowers from the harshest consequences of missed, late, or partial payments. So if you're not able to afford your monthly payment and you need some more time to get your financial affairs in order before you can make payments, know that for 12 months, if you miss a payment, make a partial payment, or make a late payment, this will not be reported to credit bureaus. You will not be considered in default with all the potential consequences we just discussed, and you will not be referred to collections. If you're eligible for this, you do not need to do anything to apply for this relief. You'll be able to benefit from it automatically. And to know if you're eligible, basically, if your loans were eligible for the COVID-19 payment pause, you are eligible for these on-ramp protections. For example, not everybody realizes, but not all federal student loans were eligible for the payment pause. For example, non-defaulted FFEL loans that were not held by the department, Perkins loans that were not held by the department, non-defaulted HEAL loans, etc. Unfortunately, these were not eligible for the COVID-19 payment pause, and they are not eligible for this on-ramp. But the vast majority of federal student loans were and can benefit from this on-ramp. Also, interest won't be capitalized at the end of the on-ramp period. And at the end of the on-ramp period, if you are not on an IDR plan, the monthly payment amount, your monthly payment amount will be adjusted automatically to reflect the higher payments you'll need to make then because of any missed payments or interest that accrued. But again, remember that if you do request or are on an IDR plan, your monthly payment amount will be just calculated based on whatever your income and household size is, like we've gone over. Okay, so I know that was a lot of information, but I have summarized it here on this slide. So if you take one thing away from this webinar, snap a photo of it and of this slide and get started with these steps. I also believe the slides may be circulated after the webinar for those who registered. And then, of course, I wanted to add that the Legal Aid Foundation of Los Angeles, or LAFLA, is here to help. So, if this seems really daunting, or if you have a complicated student loan case or any other questions about your student loans, you can call our intake line at the number on the slide, or you can apply online to see if you're eligible for our free legal services. Thank you. All right.
Thanks, everyone. This is Robin. Thank you, Kara. I am going to share out a couple of questions we received on the chat because I thought other folks might be interested in hearing the answers. And Kara, go ahead and supplement my answer if I'm not getting it right. So the first question was about interest accruing under the SAVE plan. If you're on the SAVE plan, interest will still accrue. And what happens is whatever your minimum monthly payment is will be applied to that interest, and if it's big enough, to principal as well. If your monthly payment doesn't cover the interest, that interest won't be added to your principal amount. So in other words, your interest will be forgiven. I don't know how else to say it. Maybe Kara can say it.
Right. So yeah, basically what you owe won't grow. Yeah. Any interest that accrues during, that month that's not covered by your monthly payment on SAVE, that'll just be eliminated. So you won't see the amount that you owe grow. Correct.
Okay, so that's question one. Now, what was the second question? The second question was, again, how long will it be before a person is eligible for income-driven repayment plan forgiveness under the SAVE plan? And the answer is, it's if you only borrowed undergraduate loans with a principal balance of under $12,000, it will be 10 years. There's a sliding scale if you only obtained undergraduate loans between 10 and 20,000. Between 10 and up to an amount that would make it 20 years.
Right.
And then if you have undergraduate loans, it will be 25 years.
Yeah, that's graduate loans. So if you have any graduate school, any loans for graduate school, your IDR cancellation period on SAVE, you'll have to make 25 years of payments to reach that IDR cancellation. And then just like Robin said, if you have only undergraduate loans and you borrowed a relatively small amount, that's 12,000 or less, then your IDR cancellation period is shortened to 10 years. If you borrowed more than that, but still a relatively low amount, say 13,000, then your cancellation period is 11 years. And then if it's 14,000 for your undergrad, then it will be 12 years. And then that increases per $1,000 borrowed for your undergraduate degree until you hit 20 years, which would be the maximum IDR cancellation period for an undergraduate borrower.
Thank you. Another question is, what if you have worked for the county for 5 years? Are you able to get the time credited? So this is not related to IDR forgiveness. This is related to public service loan forgiveness. If you worked full-time for the county, for a government agency or a nonprofit organization, and full-time is considered 30 hours per month, I think. Is that right? I think it's 30. Might be 32.
Yeah, I'd have to double check.
You can look
They
it up on
recently changed it. Yeah.
studentaid.gov. If you worked for 30 or 32 hours a week, and I can't remember which it is, and you have your employer certify all of the time periods that you worked that minimum amount of time, that can be credited towards your public service loan forgiveness. But you do have to get your employer to certify that you did work those time periods. And public service loan forgiveness, you have to work a total of 10 years for public service loan forgiveness. The other thing to know is you do have to be on an income-driven repayment plan while you are making those payments. So it's another reason it's important to get on the SAVE plan or another IDR plan.
Right. And for the person who asked this question too, I included in the slides a link to information about what's called the IDR account adjustment. Right. So there may also be certain benefits for you that you may want to look at. And it's a little complicated, but basically you may be able to get certain past periods of time that you were working count towards PSLF that you previously wouldn't have been, because there are certain requirements. You need, the right kind of repayment plan, you need the right kind of loans, you need the right kind of employment, etc. You need to get it certified to have those count towards PSLF. So there may be some benefits to you from the IDR account adjustment. So I would look into that in case there are any steps you need to take to get that kind of back credit counted. But you may not need to take any extra steps, and you may just be able to submit your employer verification forms and get all of that time credited. But definitely take a look at studentaid.gov, go through sort of the PSLF guidance and requirements. And then also, like I said, I would take a look at the IDR account adjustment information, just in case there's any way that, there's a chance for you to get some extra back credit that you wouldn't otherwise be able to get.
And one last thing is, it is available to people with both undergraduate and graduate loans. So that is a type of forgiveness that's available equally to both types. And another question that just came in is, if I work 32 hours a month as a substitute teacher for LAUSD, can that be considered as PSLF? And my answer is yes, as long as you're not an independent contractor. So as long as you're getting your paychecks as an employee of the LAUSD, you should be covered. And I just don't know the arrangements that there are between substitute teachers and the LA Unified School District. It's, I'm sorry, 32 hours a week, sorry. And it's either 30 or 32, so don't quote me on that, but a month is not enough. It has to be per week, a full-time job. Thanks, everyone. I encourage everyone to, if you do have questions, a lot of your questions are answered on studentaid.gov. You can call our intake line to see if you're eligible for our services. And then the third option that I always forget is the California Department of Financial and DFPI, Department of Financial Innovation and Protection, DFPI.
Protection and Innovation.
Yes, thank you. Has a student loan ombudsperson who you can also call and request help from. And I'm looking now for their information. Hold on.
Yeah,
and I will.
Selena Damian.
Her name is, yeah, here is the information. I'm just going to post it in the, sorry, I'll post it in the chat so everyone can also see that. I think that's the end of our webinar. As we said, we will, in a few days, we'll post this video online as well as the slides. And we hope this was helpful for everyone.
Thank you for joining.
Bye, everyone.